Coming into the opening bow this morning, good morning to you all. Live from Jackson Hole, Wyoming. In around about 30 minutes' time, we'll hear from Chairman Jay Powell addressing the nation and perhaps even the world on the situation with monetary policy here at the Federal Reserve. Futures going into the opening bow totally unchanged on the S&P 500. A snoozy board for you. Check out the bond market. Yields up a couple of basis points too, maybe 3 basis points higher to 3.05%. Interesting looking at twos, and we've done that all week. Two-year yields up around about 15 basis points on the week. Just short of 340 rather, before you get too excited. 3.4%. Very, very close to the high of the year. We've got Raphael Bostic, the president of the Atlanta Fed, next to us thinking 240. John, what are you talking about? What are you talking about? We've done way more than that. Lisa, just short of 340 right now.
Yeah, and how high does it have to go? Is this where it's going to stop? And we were just hearing from Patrick Harker and then Jim Bullard, Patrick Harker saying that this is perhaps where we're going to get to by the end of the year, and then we can hold. Right now we have with us, of course, Atlanta Fed President Raphael Bostic, who has provided the intellectual leadership for the region and has really been vocal recently about what's going to happen in September, and that's where we have to start. Where you said recently in a recent interview that it's a coin toss between 50 and 75 in terms of how many basis points you hike. What will determine that coin toss for you?
Well, for me, it'll be the data that comes in over the next couple of weeks. You know, PCE today is actually an important one, showing the economy is slowing down in an orderly way, which is helpful. But we also have a jobs report that's coming in, I guess, a week from now. And then 10 days later, we have the CPI. I think the three of those together will start to give me a sense of sort of the big story about how the economy is responding to our policies, and also just the changing dynamic. And if it comes in strong and starts strong, as if there's no change, I'll probably be leaning 75. If it comes in slowing like we've seen today, that's the first piece of evidence, I'll probably lean to 50.
Okay, so is there a certain threshold with the jobs data in particular that you're looking for? Because you mentioned that we saw a pretty elevated number the last time around. How is that going to inform you? What's sort of the cutoff that you're looking for there?
Well, I don't. These things. There is some art here, right? So it's not if it hits 277, then I'm good, right? I do think you have to think about this as, you know, what does the jobs number tell us in terms of trajectory? And the jobs, you know, the economy's been producing a lot of jobs on a monthly basis, 450 to 500,000 people a month, and that's a lot. I think we want to start to see that slow. And that would be consistent with the idea that our policies are starting to take demand and pull it down and reduce that imbalance that is underlying the inflation that we're seeing. So that's kind of what I'm looking for, and we'll look through it to see if there are particular sectors where there are movements that would suggest that there is some help that's coming in terms of the demand side.
There are thousands of traders on Wall Street who are turning blue now because they're holding their breath, waiting for the chairman's speech. And I'm wondering, given the disconnect that we've seen between Wall Street and the Fed and the fact that financial conditions have loosened, what's the message that you would like them to take away from the chairman's speech today?
Well, I think the message is inflation is high, inflation is too high, and we're going to do what we need to do to bring it down. And we're going to be resolute in our policy to make sure that inflation is well on its way to our 2% target. And I think that is the basic message. We've been saying that already, right? So that's not a new message, but it is important for us to be continuing to reinforce that so that there isn't uncertainty about what we're going to do. You know, we're still in a pandemic economy. I try to remind everybody that. And one of the things that's been true is that the unexpected has happened repeatedly. And so I would like for our policy, and I think my colleagues share this, to not be contributing to that uncertainty. We want people to understand sort of what our reaction function is and what we're trying to get to, and that we're not going to bounce around. We're going to be stable, resolute, and sure about where we want to be.
Well, are you willing in Wall Street parlance to be Volcker, to let the economy go into recession if you need to focus more on inflation, bringing that down because the costs are higher?
Well, inflation is extremely high. Sort of unimaginable. The levels we're at were unimaginable 18 months ago. And so we have to get that under control. That's job one. That's our top priority. Beyond that, if we start to see weakening in labor markets, but inflation is still too high, we've got to get inflation down. Like, that is the first thing. So I'd be comfortable with some weakness in labor markets if we start to see some job losses. But to be honest, we're far from that today, right? There's a lot of momentum in terms of job creation. And so I'm going to focus on the next month and the month after that. And, I think we won't have to face a question like that for quite some time.
Well, to put three questions together into one about the terminal rate, what do you think you need to get to? How fast do you need to get there? And then how long do you leave it there?
So that's three questions at once, right?
So you got to do it well.
And I'm supposed to do this in a short. I know we don't have 20 minutes, right?
No, you've got 8 minutes to answer that if you
so
want.
Go ahead.
Oh, then I got time. I'll
Take your time.
Relax.
Right. So for me, I think I want to see our policy get to something that's marginally restrictive. I think right now we are still in a somewhat accommodative state weekly. So I'm looking for us to move maybe 100 basis points, maybe 125 basis points from where we are in terms of that movement. I'd like to get there sooner rather than later. I think that the sooner we get to that level, the faster and the more dramatic our impact will be on the economy. But I also want to do it in an orderly way. I want to get to that terminal rate in an orderly way so that the markets and businesses and families don't think that our movement is suggesting there's some underlying weakness or something unexpected that's going to make people be concerned. And then in terms of staying there, I think we should stay there for a long time. And I would say I want to see the signs of the economy slowing be clear, but also start to see inflation really moving down to closer to our 2% target before we contemplate sort of moving at all. So, the word I'm using a lot is resolute. I think once we get to that level, we want to be resolute in our goal which is to get inflation down to our target.
I've got to ask this because you mentioned a time. You said a long time. What's a long time?
Oh, it could be 5 days. 4 months.
Precisely. You went there. I didn't ask the question. You went there.
Right. So for me, I think what my team has told me and what we've seen historically is that it takes a long time for the actual inflation numbers to move. The economy's got to weaken in a lot of ways. It's got to slow down. And on some level, the inflation number is the last number to move. And so where I am right now on this is, from a typical perspective, we would expect maybe 18 months, 2 years for that trajectory. But at the same time, if you look at how financial markets responded to our policy when we started moving in March, it moved much faster than we've seen historically. And we know that in the pandemic, the economy has evolved faster than we expected historically. GDP responded much faster than the analysts were expecting at the outset. So there is the possibility that the movement in inflation could be faster than what we've seen in the past. The reality is, we don't know what's going to happen.
We don't.
Right. And so I want people to know that we're really focused on the goal. And the goal is to see that inflation move. I'm hopeful it goes faster, but I can't say that for sure. So we're going to just have to wait and see.
I think what we all need then is not the crystal ball. It's just a deeper understanding of your reaction function. And we kind of danced around it just a little bit. Can you help me understand the following? If the mandate is in conflict at any point in the next 12 months, if inflation is still too sticky, but the growth side of things, the labour market starts moving in the wrong direction, do you need to tolerate that to get this lower? Is that something you're willing to tolerate?
Sure, we have to be open to that as a possibility. Look, if inflation is far from the target and labor markets and employment is relatively close to target or on target, some would say we already overshot the target, we should be willing, I would be willing, to see that those employment numbers moderate to get us either back to target if we've overshot or maybe a little further away from the target. But that further away right now is still extremely close. And so my concerns in terms of our mandate are not very heavily weighted on the labor market side, much more in inflation.
There's a belief that seems to be embedded in markets that we're going back to what we knew 10 years ago in terms of inflation being low, growth being slow, and that just sort of being the normalcy, and that rates will eventually go back to what they were accustomed to, say back then. Do you disagree with this? I mean, this is one of the fundamental questions. Are we in for a sea change in how much inflation there is globally and in the United States?
Well, I think that that's an interesting question. I actually think it's an open question. If you think about what's happened through the pandemic, where we've discovered that supply chain strategies, where you're relying on just one supplier, increases exposure to volatility and outcome and outputs. Businesses are changing those strategies. The ones I talk to, they say, look, we're no longer going to rely on just one supplier, that lowest cost provider, and we're going to do this across a number of different suppliers. That in and of itself means we're going to have higher cost basis. There's going to be upward pressure on prices that we're going to have to embrace. And so there's a lot of other things that are going on in the economy, such that it's very difficult to project that. And so I would say, I think inflation is going to wind up being a little higher than what we've seen historically. How much higher, and is it going to be material? I think we're just going to have to let things play out to understand that.
So going back to John's question about how long, and you said, could be, typically it was 18 to 20 minutes, 2 years, 18 to 20 minutes. Exactly, why don't we bring it down? 5 days, a month, or, it's been 18 to 2 years. Could it be much longer than that? Could it be that the new Fed funds rate eventually evolves to something closer to 3 to 3.5%? Is that something feasible? Not just could, but is it feasible in your framework?
Well, I think it's possible. But a lot's going to happen between now and when we get to that place, to where I'll be able to have an understanding or a sense of whether that's a new permanent and whether there is some new kind of floor that we're going to have to push to. But I don't know that now. A thing that's been helpful, like conversations like this are actually quite helpful in making me be sensitive about what sorts of things we need to be focusing on, me and my team need to be focusing on as the economy evolves for the next couple of years. So I know they're watching this, so this will be something that shows up on their list of things to do over the next 6 to 12 months.
We've got about 90 seconds left. I want to squeeze this in because we had the discussion with President Bullard as well. How does balance sheet reduction fit in? I get so many questions from Bloomberg subscribers about this almost every day. Why aren't we talking about this more? Why aren't we talking about this more? Where does it fit in?
Well, I think it fits in as an additional tool to policy, and the reduction of the balance sheet will have sort of a more restrictive impact on how the economy evolves. We are very early on in the reduction of our balance sheet, and we're still ramping up in some regards to get to a level of that we can start to reduce much faster. For me, I think that it is another factor that allows us to say the economy standing on its own. It doesn't need these additional supports.
Yeah.
And so the energy in the marketplace is just less. And that's kind of how it plays out. I saw the segment you did with Jim, and trying to come up with a hard estimate about $100 billion. What does that translate? It's very difficult.
It's super hard.
But I think it's unambiguous that there's less energy that we are contributing to the marketplace, and that means that the ability for the economy to grow faster is just really good.
We've got to go, but I'm told you and I are going to watch some real football in Atlanta at some point.
Come on down.
Live from Jackson Hole, Wyoming this morning. Good morning to you all. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Brownbitz. I'm Jonathan Ferro. Moments from now, about 13 minutes away, we'll hear from the chairman of the Federal Reserve, Jay Powell. We've caught up with the good and the great over the last 48 hours, and TK, this one's the big one, isn't it?
It's a big speech, but what's interesting is how it will be interpreted, and that's wrapped around data. I can't emphasize enough how we've shifted from forward guidance and blah, blah, blah.
You're happy to move away from the blah.
The data
blah.
matters. Like, guess what we got? Good inflation
You've
this
filled
morning.
the gaps in, Tom. I'll give you that.
Good.
They've taken away the blah, blah, blah.
I'm trying to channel you. I took my raincoat
I like that.
off.
This is a better look.
You know, well, it's a little warmer.
What did we learn, Lisa? What did we learn?
Over the past hour, honestly, we've learned that there is more of a likelihood that they want to keep rates at a higher level for longer. That, to me, has been the big takeaway.
Well, this is what we've also learned this morning. Beijing and Washington have reached a preliminary agreement to allow American officials to review audit documents of Chinese businesses that trade in the United States. This has been a massive, massive issue for a long, long time. I'm pleased to say that dropping by to catch us up with us very, very quickly is Gary Gensler, the SEC chair. Gary, great to catch up. So I feel like I've been talking about this for at least a decade. Is this the one? Is this the one?
Well, this, as I've been saying, this proof will still be in the pudding, but this is unprecedented. Tom just said something about the data, and I'm not talking about the data that you were referencing, but when investors invest in companies, they need to ensure they look at financial data, and they need to know that that financial data has been checked by auditors. And guess what? That the auditors have somebody looking over their shoulder as well. That there's somebody auditing the auditors. And that's our basic system of checking data in our capital markets. And 20 years ago, Congress passed a law, and 20 years later, the Chinese still had not complied with that law about allowing inspections of the auditors. We have this unprecedented arrangement signed this morning, but we still need to see over the next several months whether there'll be compliance and whether our inspectors from the Public Company Accounting Oversight Board will be able to do the inspections when they go to Asia.
Yeah. Gary, can you give us a sense of what went on behind the scenes to get to this point? What did the U.S. have to give up to get China to allow this type of oversight?
Lisa, it's actually a little bit different than that. It's that we have the world's deepest, most liquid capital markets, and I think that Congress stepping in December of 2020 and then reaffirming again in the summer of 21, and my shout out to Senators Van Hollen and Senator Kennedy, bipartisan, who led that effort, to say that there was a clock, that there was going to be a 3-year clock. If China didn't comply, all 200 of these companies are going to have to leave our U.S. capital markets. And then the SEC and this other organization, the PCOB, in the last year and a half have been really effectuating the will of Congress. And I think when we Americans speak with one, bipartisan voice, unanimous voice from Congress, from the SEC and the PCOB, I think the Chinese had to take a look at this and say, you know what, we want to continue to have this access. So actually the agreement is more prescriptive, more detailed, more specific than any that are with any other country, because we've had, as John said, these 10 or 15 years of non-compliance. And the proof will be in the pudding. But I do want to say that it's been constructive, productive conversations with the Ministry of Finance from China, with what's called the CSRC, the China Securities Regulatory Commission. And we were always into problem solving. How can we get to the important compliance? It's a simple idea that we can check the auditor's work papers, we can take testimony, that we can select whatever.
It's so simple for so long. I feel like it's ridiculous that we've only just been able to come to an agreement, and I know you think exactly the same way. I've got to squeeze this in because the chairman's going to speak any moment from now, so in just 60 seconds if you can. You said the proof is in the pudding. When is the pudding served? When do I know that this is actually a success? When will you know?
So we'll be sending the inspectors, these PCOB inspectors, starting mid-September. It normally takes about 3 months to finish up that work. So by December, I think we will know for this year whether it's a thumbs up or if it's a thumbs down. Then, of course, then these companies may need to leave the U.S. market.
Gary Gensler, thank you so much for joining us on this historic day. Greatly, greatly appreciated. And
Thank you, and good luck with the
Jason
rest of your
Furman
day.
with us. Thank you, Gary. Greatly appreciate that. And joining us now, Jason Furman, who has stole the dialogue of the last few days with incredibly important comments on some of the legislation and decisions we've seen in Washington. Jason, on Wednesday, you will be at the acclaimed EC10 of your Harvard. You will be teaching core economics to young, eager freshmen. How will you fold the student loan debate that you are so critical of into classic EC10 lecture?
Look, I don't think we're going to get to that one in the first lecture, but one thing we really get our students to think hard about is separate your values, how you think you'd like the world to work from how it actually works. You see that in monetary policy too. I root every day for higher wages and lower unemployment, but if the world doesn't work the way that all is consistent with low inflation, well, you have to deal with the world as it is, not the world as you want it to be.
You've been both sides of this, on the economic side and also on the policy side as well. Where did the Democratic Party go wrong on this?
On student loan debt relief, we're just, in an economy where we are now, the Hippocratic Oath should apply. And $500 billion, twice the campaign promise of relief for student loans, which are really targeted, going up to people who make up to $250,000, couples that make up to $250,000, that just violates the Hippocratic Oath.
I think people have mischaracterized what you've said this week, and I want to give you the opportunity to talk to our audience about what you actually think this will do, how it will contribute to inflation. You've been quite precise with numbers, so let's take the opportunity to go through those numbers. What do you think it actually means for inflation?
Yeah, I think relative to a world where interest payments were resumed, and that was what was supposed to happen, absent this, the inflation rate will be maybe 0.2 or 0.3 percentage point higher. You can call that a small number for inflation if you want. It's sort of a rounding error compared to the huge thing we have. Or you could say, you know what, when you're above where you want to be, you really don't want to be moving in that direction, and it's about $200 a household. But that's my number. If people want to argue what adjective to use, I have no expertise in adjectives. Mine is in numbers.
We're about 5 minutes away from Fed Chair Jay Powell coming out and talking, and this relates very directly to what he's going to talk about in terms of the longer run inflation rate and what they have to do to combat that. Are you in the camp that there's going to be a protracted new period of inflation that perhaps has not trickled into the market zeitgeist as much as it should have?
I think there's a lot of persistence in the inflation right now. You look at compensation growth, it's running at about 5.5% a year. You just can't have that level of compensation growth without an inflation rate of about 4%. And so the question is, why would compensation start growing more slowly? Maybe that magically happens, job openings come down, soft landing and all of that. Historically, though, it hasn't happened without a decent-sized rise in unemployment. I don't think they need to cause one, but they can't shrink from one either.
Based on that, and based on the possibility of that kind of protracted inflationary read, do you foresee a 3.5% to 4% interest rate over a period of years? And is there the sustainability in this market to handle that, given how much debt we have?
I'm worried about the disconnect between what markets think. I think the Fed speakers could not be clearer about we don't intend to shrink from this and lower rates. They're just so consistent, so clear, and I just don't understand why no one believes them. I do believe them. I think we're going to need rates, 4% for a while. Now, maybe we have a recession. What's a while? I think absent a recession for years. With a recession, you cut rates, but then you're probably going to need to raise them up decently high again afterwards. Because historically, with inflation like this, it's not like, one recession, one whatever, and you're done. It can pop back. You can keep grappling with it. I think a 5% rate 2 years from now is more likely than a 1% rate 2 years from now.
Jason, this was great, and I know you want to get inside and hear what the chairman's got to say as well. Jason Furman there of Harvard University. Lisa, this has been a big conversation for us this week. There's just a feeling from the economists like Jason that we've been speaking to all week that this is not going to be temporary. This is going to be something we might live with for a while.
And that's not trickling into markets. And this really shows the divide right now on Wall Street. And we started the day very early with Stephen Major over at HSBC talking about the concern about going back to where we were and even lower rates. And the divide is just going bigger and bigger with those seeing the opposite.
Chairman Powell's going to speak momentarily in about 2 or 3 minutes' time. Going into that, your equity market is essentially unchanged on the S&P 500. One thing you do see, though, take a look at that. What's that? Euro strength. Yeah. Dollar weakness. Yeah. 1.0063 on euro dollar. Of course, the theme today has not been the theme of the year so far for foreign exchange.
And this isn't driven by the euro kind of strength. This is driven by perhaps a little softening in the dollar on the heels of some of that economic data. It's not exactly something that's coming from this feeling that the ECB is going to hike and get some
big moves in the bond market off the back of that data this morning. Just PCE coming in a little bit softer for July, in line with what we saw for CPI as well. Yields on a 10-year up about a basis point to 3.037%. On a 2-year yield, basically unchanged at about 3.36. We've talked about how close we've come to 3.40 through much of this week. 3.45, the high of the year. Steve Major, you mentioned Steve. He thinks, like many of our guests thinks, for the 10-year, we've seen it. We've had the high. 3.0371% on the 10-year right now. Mike McKee, pop it into the seat. Mike, the chairman, about a minute away.
Yes, and it's going to be a big moment for everybody on Wall Street who wants to know how tough he will be, what is the strength of his message, not so much what is his message, but how strong and forceful is he going to be about trying to bring down inflation.
What happened to the walk? The walk, is that afterwards now?
I think it's going to be afterwards. Maybe it's a little too cold. They saw you guys shivering out here and decided we're not going to do that.
Thank you, Tom.
How much are the presidents? One of the great shocks here, folks, at Jackson Hole, for those of you on radio, it's a beautiful lodge, beautiful windows, and all of a sudden, all the bodies that we look at discreetly are all together. Are they on the same page? Do the presidents argue like cats and dogs? Are they all pretty much, do they have Venn diagrams that are pretty much overlapping?
The Venn diagrams would overlap a lot right now.
Okay.
There's just a strategy is universal tactics are being discussed.
All right, so right now we're looking just moments away here from Fed Chair Jay Powell. And really the question has been, how long do you hold rates at a high level, the terminal rate? Do we expect to hear more from that with Fed Chair Jay Powell, given that that's sort of the feeling right now?
That's going to be one of the key questions we'll know in just a few moments.
We're going to hear from the chairman of the Federal Reserve. Let's listen in.
Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. The U.S. economy is clearly slowing from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum. The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting. We are now about halfway through the intermeeting period. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook. At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Committee participants' most recent individual projections from the June SEP showed the median federal funds rate running slightly below 4% through the end of 2023. Participants will update their projections at the September meeting. Our monetary policy deliberations and decisions build on what we've learned about inflation dynamics, both from the high and volatile inflation of the 1970s and 1980s, and from the low and stable inflation of the last quarter century. And in particular, we're drawing on three important lessons that I'll highlight. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. It may seem strange now that central bankers and others once needed convincing on these two fronts. But as former Chairman Ben Bernanke has shown, both propositions were widely questioned during the great inflation period. Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. It is true that the current high inflation is a global phenomenon, and that many economies around the world face inflation as high or higher than seen here in the United States. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored. That is broadly true of surveys of households, businesses and forecasters, and of market-based measures as well. But that is not grounds for complacency, with inflation having run well above our goal for some time. If the public expects that inflation will remain low and stable over time, then, absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions. As former Chairman Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself, so part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. One useful insight into how actual inflation may affect expectations about its future path is based in the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decisions. When inflation is low and stable, they are freer to focus their attention elsewhere. Former Chairman Alan Greenspan put it this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter business and household financial decisions. Of course, inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And that brings me to the third lesson, which is that we must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay, as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
The chairman of the Federal Reserve in Jackson Hole, Wyoming, with a pretty strong message to this market, to this country, and maybe to the world for that matter as well. And we've got more work to do.
Yeah, absolutely, John. And I'm just thinking that the next press conference should be 8 minutes, 38 seconds.
Wouldn't that be good?
That would be good.
Wouldn't that be good? I'll go through some of the price action for you off the back of those comments this morning. Yields higher, particularly at the front end. We've been talking about that throughout the whole week. Through 340 on a 2-year, yields up by around about 7 basis points. On a 10-year, up by around about 4 basis points. On a 10-year to 3.065%. The equity market's shaping up as follows. About 40 minutes or so into the session, we do pull back, but not in a major way, by about 0.5% on the S&P 500. On the Nasdaq, down by 5 or 0.6%, and recovering, Lisa, in the last couple of minutes.
So what I found interesting, this was Jan Hatzia's view of the world, what we've been hearing all morning for some time. Restrictive policy for some time. We need to not loosen too quickly. We're not going to cut rates so quickly. That's basically what he's trying to say. And he's trying to send a hawkish message, which was heard by the front end. Now the question is, the pain that he's talking about, do people think that we're still going to get that soft landing? Is that what's being reflected in the bounce back of the stocks that we're seeing?
How many times have we heard this Fed chair talk about the strength of the underlying economy? Tom, we heard it again there.
It was there, and it'll be with the data that we see out here in the coming days, and frankly we saw it with the good disinflation data today. I found it interesting not only the brevity of the speech, but to the point of he and the people advising him, boy, was it structured. A first lesson, a second lesson, a third lesson. Only Mike McKee knows the fourth lesson.
Well, Mike McKee, there was a moment at the very start of that speech where he acknowledged the pain currently and the pain to come in this economy. Do you think they're setting us up for something important later this year?
I think what he's speaking in Fed euphemisms, of course, because he can't say recession, and he's not going to say we're going to throw a lot of people out of work, but he's basically making the point that we are okay with that, and we expect that to happen. We're going to see some people lose their jobs. Inflation is going to come down, but we're going to keep at it until it does, and that will cause pain in the economy. And I think the whole idea here was to sort of take Wall Street by the throat and shake them and say, we've been saying this all along, but specifically A, B, C, get the message. This is where we are.
Jim Bullard, in your chair moments ago, iconic for regime change, a different way of thinking. Is this a chairman with his brief speech today signaling theoretical or process regime change at the Fed?
No, I think he's just saying this is where we are now. This is where we have to go. And so between here and there, there's going to be higher interest rates. There's going to be pain. After that, when they bring inflation down, that's a question for later on, which is pretty much what Jim was telling us. You got to get through the current situation first. And the problem that the Fed has faced is that the market has been fighting them. And now he seems to have slapped them upside the head, as they would say out here, and hopefully got their attention.
Hold on a second. He slapped up the up on the side of the head, or whatever you just said, and yet we're not really seeing the reaction. Almost all of the losses are almost retraced, and we're down about 0.1% now. So talk about how they're perhaps perhaps not getting the message, or are they, right? Is this the message that they want to see? Are people basically not buying that the Fed is going to allow this kind of deterioration in the labor market? What is the market seeing that seems to be different than what Fed Chair Jay Powell is saying?
Well, I think what we've had is so long a period of low rates, and we had a number of instances in which the Fed put came into play, most notably back in 2018, that the market is saying we want to see proof, not just words. And you're going to have people who are going to test the Fed on this. And there's nothing that Powell and the committee can do right now to prove. It's just going to take time. And so at this point, the market's going to argue about this, but I don't think you're going to see them run away in the direction that they were going before.
To your point,
with equities
Mike,
just...
The proof is going to come at that very moment when the dual mandate's in conflict and they're still hiking interest rates.
And he made it clear where they're going to go when that happens.
And I don't think many people buy that, because what happens when we get a weak number? There's a real belief that it fades the Fed story.
Correct.
There's a real belief that that's going to be the bad news is good news story.
Okay, well, here's the problem, and this is what we've heard all morning, is that what happens if you get that higher tick up in unemployment, but inflation is still high, right? And that's the real conundrum, because people now are saying, again, this goes back to they have the belief that we're going back to what we've always known. Fed Chair Jay Powell not necessarily buying that.
We've had Fed presidents sit in Mike's seat telling us what they're going to do, Mike.
Yeah.
You've heard it yourself.
Yeah. Well, that was, I think, the reason that Powell went to lengths to explain why you don't back off is a message in itself. The first red headline on the Bloomberg terminal was that Powell says you can't go backwards. You can't, you have to keep at it. And that's the message that they want to deliver, that we're going to go through this. We're going to bring inflation down. There'll be a cost to that, but we're not going to change our minds.
When in doubt, look at the footnotes. And there was the academic moment with Sims and Benjamin Friedman, who was one of my first interviews at Bloomberg. He is the giant of how nations think about growth. Can they pull this off with recession-like growth, whether it's a growthy recession, NBER recession, whatever America's feeling now? Can they pull off all this happy talk given tepid growth?
Well, that's the remains to be seen part. That's the part that Wall Street is challenging, and that's the part that Powell tried to push back against today. And he talked about a period of under-trend growth, low, slow growth. Right. So he can't come out because of his position and say, yeah, recession's likely, because then the markets would tank. But he can sort of hint that this could happen, and we're still going to push through it.
Oh, Michael McKee, thank you so much. Just great coverage today. John, is this the most controversial market economist in America today?
Who's that?
Introduce right
Mike
now?
McKee or Chairman Powell?
No, not President McKee. Let's bring in Anna Wong. She is Bloomberg Economics, and she has set the world afire with an exceptionally aggressive outlook for inflation. Anna, let me begin with the simple question. If we get an Anna Wong interest rate regime, what happens to American economic growth?
As Powell said, what's important, what's the bedrock of American growth is price stability. And if you do need a terminal rate of 5% to get there, that would be good for American growth if that restores price stability.
Well, we would have price stability, but what would it mean for unemployment and jobs? When you work through 4 3/4, or dare I say a 5% interest rate, how do you model that with labor in America?
Well, it's really about real interest rate, right? So even if underlying inflation is actually running at 3%, then a 5% nominal interest rate is just 2% in real interest rate. So depending on whether it's a real interest rate of 2 or 1.5, and if that's the case, I think that would be just a normal way of things. But of course, as the Fed is tightening, there will be impact on the labor market, and that's just a cost that the Fed will need to pay for being slightly delayed in tightening monetary policy.
Anna, this was, by many accounts, a quite hawkish speech. We are seeing a reaction in markets barely. Right now, I'm looking at the S&P down 0.25%. Is this market unrealistic right now from your perspective economically?
Well, I think the market is slowly getting the message that the Fed is unlikely to ease in 2023. But I think my assessment is that the speech we just heard is, if I have to rate it in a scale of 0 to 10, 10 being most hawkish, it's around 6. I think the lessons that Powell explained from the 70s, the first lesson he said that, monetary policy alone can bring down inflation. Everybody agreed that lesson likely won't be repeated. But I think the lesson that could be repeated, and he did not talk about this really, is that Arthur Burns did raise nominal interest rate well into a recession. In fact, generated one of the deepest recession that the U.S. has ever seen back in 1974. So he did not say that the Fed would be ready to, hike well into a recession.
Right.
And yeah, so I think
Right.
that's a mistake that is.
I'm seeing a significant market reaction right now, John. We have a 2-year yield which has moved out to a new high, and I think it's profoundly significant. I don't think it's a small matter.
It's up around 5 basis points at 341. I don't happen to think these moves are massively dramatic off the back of the
market move
speech.
isn't there, but the 2-year speaks volumes.
But I do think the emphasis of this Fed chair is important, or perceived emphasis of this Fed chair. In a news conference at the last Fed meeting, there was this feeling that he kept talking about neutral, which implied to some people that maybe they were almost done.
Right.
And I think what this speech has done is almost correct that address in that news conference. Mike, do you get the same feeling on that front?
If there was one line in here that I wondered about, was he repeated the idea that at some point monetary policy changes will slow down. I think that was one of the lines that was misinterpreted by Wall Street the first time he said it, and I was surprised he included it again, because if you're looking to make the case that the Fed is going to be too easy, that's one of the things you can use as your proof. He means we aren't going to do 75 forever, but the markets could take that differently, and I don't think that's the impression he wants to leave.
Anna, dare I say, do you think that this was somewhat of a cleanup act for the last news conference?
Yeah, I definitely think so. He did say that, even with a soft July print, he thinks that the labor market is still strong, so underlying momentum is actually strong. And he did hinted that the neutral rate, the short-term neutral rate, could be higher. So I'm expecting, and I think he's previewing that in the September FOMC, we might be seeing that the R-star could be revised higher.
Anna, great to catch up with you. Anna Wong there of Bloomberg Economics on her ideas of what we've just got from Chairman Powell just moments ago. Tom.
I think we need to reframe here very importantly before Ira Jersey, John, the interest rate debate. Help me here with the names, Lisa, as well. There's a group with the lower regime, Kovanovic at JP Morgan, clearly there. But there's other names saying what? 3.5, 3 3/4.
I think we've got a perfect guess in about 10 minutes' time. As we catch up with Andrew Hollenhorst in just a moment.
And he's higher.
Over at Citi.
He's
at
higher.
4% year end.
Yeah.
And Anna Wong is way up here with a select group. Dudley, I would put up there, maybe not quite as high as her. But there's a real dispersion.
Let's take Chairman Powell's comments as a given, that we've got a really strong underlying economy. What does that imply? That if you want to get demand down, let's take Mike McKee's interview with Esther George earlier this week. If you want to get demand down, you need to get rates up. And if you believe that the underlying economy is robust and strong, then clearly they've got a lot of work to do.
But Lisa, where's the given on a strong underlying economy for X% of America that's flat on their real wage, negative real wage back?
Raphael Bostic said something that's a little concerning on that front, which is that inflation is the last thing to move, that you have to see the weakening before you see the inflation really come down in a more material way. If that's the case, we have a long way to go and a lot of weakening to see in that data that we're not going to get in real time.
The difficult pill for this market to swallow is when you get that weak economic data, whether it's in the labour market, you start to see unemployment climb, and if inflation is still sticky and they're out there telling you we're still going to raise interest rates, that is when the penny will drop for a lot of people.
And especially at a time when a lot of people, the new consensus is that they're going to raise rates not beyond 4, maybe to 3.5, 3 3/4, and then sit there. That's the new consensus rather than going to the 5, 6, or possibly
but that's
north
what
of
they've
that.
been saying all along, and nobody was listening to them.
They're listening.
So Powell's hoping he
But
gets
Mike,
that out there.
They're not going to listen until we actually see that economic data.
That's the problem
And
for
they
the Fed.
turn around and say, we've been consistent about this. This is what we're going to do. Ira Jersey's going to join us now from Bloomberg. Ira, I'd love your take on that speech from the Fed chair from the last 20 minutes.
Well, I actually think that the most important thing for the Treasury market and that two-year yield that Tom was noting just a second ago is really the full court press that seems to be on by Fed members, that once they reach whatever that terminal rate is, whether it's 3 3/4, 4%, somewhere around there, that they're going to keep it there for quite a while. And for something like the two-year note, I think that means that fair value has to creep up, and that we'll wind up seeing yields above 3.5% for the two-year yield, and that will likely continue to flatten the yield curve a bit further. And you've seen some of that reaction over the last 20 minutes since the speech from Jay Powell dropped.
Ira, can you give me a number, just give me an idea of where this is going? 2s10s right now at negative 36 basis points. What kind of numbers have you got in mind?
Yeah, so I think about negative 60 will be the trough in how inverted that curve gets, and the longer that the Fed keeps that rate, and the market expects the Fed to keep the terminal rate, say at 4% for 9 months or a year, the longer that inversion can remain there. We saw a lot of volatility in the yield curve recently, and one of the reasons for that is that positioning is so one way right now, because the consensus still is what we're thinking, that the curve will flatten further. So what happens is you get these bouts of people just taking risk on and off, particularly in very low liquidity August trading.
Well, Ira, do you think that there's enough of a consensus forming to remove some of that volatility, at least in the front end of the bond market? And I say this understanding that we've moved a lot, but have we moved to a point that Fed officials themselves are telegraphing they're going to get to later this year and possibly hold at? Do you think that this is actually going to yield to lower volatility in the all-important rates markets in the next few months?
Well, I think to your point, the two-year yield volatility actually is not what's driving the inversion of the yield curve going from negative 20 basis points to negative 40 basis points. It's really what's gone on in the longer end of the curve. So really what's been going on in the 10-year and the 30-year bond, because the market is sometimes thinking that, the Fed's not going to go far enough and that there's going to be more inflation in the future, so the 10-year sells off, and then other times you see some data that suggests that we're in a recession or headed into a recession, and then people buy the 10-year and you wind up seeing big rallies. So really at this point, I agree with the idea that the Fed expectations are kind of anchoring the two-year yield, but you can still have very wide swings in the 10-year, and especially given how poor liquidity is, and probably will be through Labor Day.
I very quickly here, we see the Bloomberg Financial Conditions Index become a little bit more accommodative. Translate for fixed income markets the signal that we get from financial conditions that just won't get painful like the chairman wants.
Well, so a big move in the financial conditions has really been what's gone on in credit spreads and in the equity market, because you've seen a significant rebound in those markets, and a lot of financial conditions indices use those as a baseline for how easy it is for people to borrow. And what that means is that the Federal Reserve will have to probably hike a little bit more. I tend to be a little bit more in the 4 to 4.5% camp for where we're going to see the terminal rate. I think 5% is probably a little bit further. So the Fed has to do the job of actually tightening financial conditions because the market isn't doing it for them. So I think that means that the Fed is going to have to go a little bit beyond what's currently being priced.
Yeah, Ira, thank you. Ira Jersey there of Bloomberg. Might sound a little bit controversial just 15 minutes after Chairman Powell looking ahead to a September meeting for the Federal Reserve, but the ECB meeting is taking on a little bit more importance at the moment, right?
I underplayed this, and I just want to say, people reached out to me and said the Euro story is a Euro story because of the possibility of a 75 basis point rate hike in September by the ECB.
Did you hear what Ira said on 2s10s, negative 60?
Yeah, well.
You know who's joining us shortly? Priya Misra.
All right.
Oh,
there we go. There we go. That's coming up from Jackson Hole. This is Bloomberg.
economic fallout is.
Live from Jackson Hole, Wyoming this morning. Good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Moments ago, we heard from the Fed Chair, Jay Powell.
The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them.
That was Chair Powell. Jay Powell, the Federal Reserve Chairman, just moments ago. And I have to say the market reaction, it's not been big, has it, Bramo? It's not been big at all.
No, Tom picked up rightly so on the front end of the yield curve because that's the arguably most interesting move out there. That is reaching new or close to the year highs. At what point do we get that going beyond the Ira Jersey side of things with some kind of credence given what they're saying?
Have you seen what's happening in Europe this morning?
That's the story to me right now. I'm actually kind of distracted from looking at the
two-year in
Italian
Germany.
spread.
Do you want this number? Of 17 basis points right now. We're through 1%
This
again
is important.
on a German
The
two-year.
character of the energy prices there are not parabolic. There's some math here we don't need to go into. They're becoming elements of what the great Steve Hanke at Johns Hopkins talks about, where they shift from a nice, cute parabola to something different, more urgent.
Do you know where we were the first day of August on a German two-year? 26 basis points.
Well,
We quadrupled.
It's across Europe, but remember the Czech headline this morning? The Czech headline.
Sure, yeah, we've got an energy problem.
This is not just three
Massive
big
energy
countries.
problem.
Well, it's more than an energy problem. It's a dollar problem.
Yeah, agreed.
And the stronger the markets think the Fed is going to be, the tougher it is for the Europeans because they're much less competitive in terms of selling.
Mike, we came into this, and if you'd asked me in 2020, could we go a whole cycle without the ECB hiking interest rates again, I would have probably said yes. And now we're talking about the prospect of maybe, I'm not saying it's going to happen, but perhaps 75 basis points on September 8th and not 50.
So let's put this into perspective. Reuters reporting that some officials want to discuss a move of 75 basis point at the September meeting. That has triggered a near 1 in 2 chances, a coin toss of a chance that's being priced into the market that the European Central Bank will raise rates by 75 basis points in September.
Wow.
When we're talking about a 75 basis point rate hike, we had been talking about the Fed. Nowhere was the ECB on the table. Now we're talking about
a couple months ago, we were talking about a 10 basis point move.
Mike, don't we have to wait for the data to determine 50 or 75 beeps?
For
Well,
who?
here in the U.S.,
Where are we talking?
we're gonna have to wait. It's interesting. The market moves in the futures markets are still priced right in between 50 and 75.
Okay,
So Powell did not move the
Now, what
market
about
really
Europe?
with that. But with Europe, the data we know are bad. They're in a kind of they're sort of
terrible.
ahead of us in terms of
Mike,
going
you
down
said
the
it though.
cliff.
You alluded to it. Does the ECB have a Fed problem?
Yeah.
In some ways.
The ECB does, the Bank of England does. The Bank of England has a lot of other problems, but the strength of the dollar and is a real problem for all these countries, and it's only getting stronger because the Fed is perceived as being more hawkish.
I would note Kit Jukes at SocGen, a single line within 3-4 paragraph note. It's all about energy. I go back to the theme. The geometry of the energy charts is not
Vertical.
human. It's not.
It's gone vertical.
Elements of vertical.
It's
Elements.
gone
It's not.
vertical.
You know, the cliche is Zimbabwe or pick your other EM that blows up, but the bottom line is vertical captures it.
15 basis points on the front end in Germany to 1.027%. Who would have thought 30 minutes after Powell, the ECB would take over the headlines?
Although maybe not a coincidence, and you're seeing the actual response in the euro, which is interesting.
Let's head over to New York and get you up to speed on the market action, the price action with Kelly Lyons. Hey, Kaylee.
Hey, John. Well, it's been a bit of a roller coaster. Immediately after Chairman Powell took the helm and said, we're going to get restrictive, stay there for a while. We are not going to prematurely cut. You saw stocks pretty much dropping like a rock. But then the market seemed to question whether or not they knew that already because they quickly recovered. But now we are back down near session lows, down about 1.4% on the S&P 500 as we digest the idea that maybe that pivot narrative might actually be dead. And interestingly, it is the NASDAQ 100 that is actually underperforming given those tech-heavy indexes are very interest rate sensitive. And you are seeing some some movement in rates off the back of Powell, specifically at the short end, which you guys have mentioned. The two-year yield is up more substantially after his remarks, up about 5 basis points. We're right now just south of 342. Well, the 10-year is up about 3 basis points. 305.39 right now is where we trade. So again, a more inverted yield curve. And you guys were talking about the euro. Is it a product of euro weakness or dollar strength? But the dollar right now is weaker on the day. The dollar index down at 108.10, down about 0.3%.
Katie Lyons, thank you so much in New York. There are people that are signposts along the way. There is research where you stop and you say, oh, and that was a number of months ago with Priya Misra, truly one of the great calls of 2022 on the dynamics of the yield curve, global head of rate strategy at TD Securities. Priya, readjust here off of the Powell speech. Readjust the dynamic between the short-term 2-year yield and the benchmark 10-year.
Sure, thanks for having me. I think the front end is all about near-term Fed policy, and I think we got a few clues from Chair Powell's comments today. You know, he's acknowledging that there could be pain ahead, and that suggests tolerance for pain, I would argue. He's also talking about being restrictive for quite some time. So this idea that the Fed will take rates up to terminal and then quickly cut rates, I think he's pushing back against that. So that front end, I think, is still biased higher in rate. We're looking for 2-year rates to continue to rise, really getting close to that terminal level. So, you know, is that 375 or something in that range? The long end, I think the long end is a lot more anchored because I don't think long-term neutral rate is a whole lot higher. The long-run neutral rate, there could be a higher short-term neutral rate, but the long-run neutral rate, the fact that global growth is slowing, the treasuries are still the safe haven asset. If you're in risk assets right now, the Fed's just telling you that that put is much further away. I think long-end treasuries are actually a safe place to be in. So I think that flattening bias here continues. The curve keeps inverting. The long end, I think, is much safer than that front end. That's all a function of inflation data.
Priya, the fancy word for pointy is stochastic. And curve inversions are almost always in every case stochastic. Do we have to get used to this? If we have a longer Fed regime, are we going to have longer, deeper curve inversion?
I think inflation is what is likely to make this longer. The fact that inflation is just inherently more sticky and a lagging indicator. I mean, growth can be slowing. Inflation might be the last thing to respond to it. And the Fed's telling you that it's public enemy number one. So I do think that the inversions that historically have been short-lived because inflation has not been a problem. And so the Fed has the flexibility to respond. They're telling you that if inflation doesn't decelerate, that dual mandate is very lopsided. And therefore, a period of sticky inflation will mean that that inversion, I think, lasts for much longer than the market's pricing in or that, people are looking for.
Priya, given how they're setting up their reaction function here, and given how little the market seems to be listening to them, how do you think this market would respond to a bad labour market print, a bad payrolls print on September 2nd?
So define which market. I think there could be some risk assets that could be actually comforted by a weaker number because then that might mean the Fed may have to respond and may not hike as much. I would actually argue it would be risk negative. I think bad data is bad for risk assets and treasuries. I think it's good for long dated treasuries. But the front end, I think Chair Powell's telling you, well, we're going to have to tolerate some pain. Inflation is still the data print that I think the market will respond a lot more to. I think sensitivity will be higher to inflation because that's what the Fed's watching. A weaker payroll report, if it means a weaker wages down the road and ultimately weaker inflation, I think it can allow the Fed to slow down, but not with inflation running as high as it is right now. So I still think that CPI report, unfortunately, in another blackout, is probably the linchpin for the 75 or 50, and we didn't get much from Chair Powell. But I think they're trying to move us out of just the pace of hikes to that end point and how long they stay there as ultimately what will tighten financial conditions.
Priya Misra, we are in Jackson Hole talking about the Fed, talking about the United States, and so I feel a little strange doing this, but we need to pivot to Europe because that is really where the incredible action is, at least in the markets today, as people start to think about a 75 basis point rate hike by the ECB. Do you foresee this as actually a real possibility and something that could sustain some of the moves that we've seen that are quite dramatic in the German bond market, in the Italian bond market, and certainly in the euro?
Right, so we're still looking 450. Now, is there a case for 75? There is. When you're just starting out in the hiking cycle, you could make the same case for the Fed. Should they have gone, should the first hike have been 75? And the minutes suggest that it might have been had we not had the Russian invasion. So I think it's a possibility. They need to set the market up more. They also need to look at unintended consequences. I think the ECB is in a much harder position than the Fed because they're dealing with an energy crisis that's only going to get worse as winter sets in. Our thought is that 50 is still a sizable number, especially for the Eurozone that's been dealing with negative rates for so long, that they would still start with 50. But I think if they set the market up, they talk about how they are going to address the problem in the